Get a flavor of what really is the quarter going to be like and what's the way forward. JC Sharma, Vice Chairman and MD at Sobha Limited, joins us on the show right now. Mr. Sharma, morning. Good to have you on the show. Overall, how is it that you're looking at the numbers? It seems like a bit of a mixed bag. While volumes are up significantly, the realization trends continue to be muted. How do you see this trend pan out going forward?
Good morning and a very happy new year to your viewers. This quarter which had gone by was one of the tough quarter looking at the overall macro scenario, and in which, thanks to the Bangalore market doing well and despite some kind of a slowdown what we had seen in our Cochin market, we could do 1 million square feet plus of new sales. There has been an improvement in our realization also on a quarter-on-quarter basis. Prices seems to have been stabilized. Demand remains prima facie intact in our key markets, but somewhere the tentativeness continues, and we believe that post this SBI interest reduction in interest rates, some kind of a benefit and some kind of a demand revival is expected, and this fourth quarter should still be better than the third quarter. Overall, we hope that we should be doing better than what we achieved in the last financial year, despite being a tougher year overall for the industry.
All right. Now we have seen the growth in Sobha share, and that was weighed down by the greater share of JD projects. How are you evaluating the structure for JD that you have presently? Is this a lower risk structure that is working well for the company?
We will not say from a risk perspective, because at the end of the day, whether it is our own project or a JD project, the risk of the developer continues to remain quite high vis-a-vis the RERA customers and other authorities. Prima facie, we feel that 20% of our sales should be happening through the JD part, and the remaining should be coming through our own projects. Going forward, this kind of a ratio should continue, and this gives somewhere the capital deployment strategy working in our favor, because more we buy land, more we need to invest money, and that part is taken care of without suffering the growth.
You know, your new project launches have lagged expectations in FY20. What was the primary reason for subdued newer launches, and is it mainly because of the lack of demand trends or due to the lumpy nature of the business itself?
Both. See, prima facie, we still have got huge inventory ongoing. And we have also noticed that gradually the customers are shifting to the projects which are almost complete or completed. While Sobha does not have a good number of inventory on the completed side, but the sales momentum is seen more where the project is about to get completed. So keeping that thing into mind and keeping that we have got a large quantum of an inventory, we are not pushing very hard for the new launches. However, at the same time, there is a clear visibility that 10 million square feet plus some more new projects are likely to get added, and company will have comfort going forward from the new launches and the benefits to be accrued from such launches.
Okay. And any incremental and meaningful launch pipeline that we can expect in the fourth quarter? I mean, will FY21 in that sense be better in terms of launches?
I think FY 2021 will be significantly better from the new launches. Few launches should happen in this quarter as well, but 2021 should be the year of a maximum number of launches.
What about your net debt currently? How do you see your overall debt levels trending?
See, as far as the liquidity and the debt level and the interest costs are concerned, they are all well within our defined parameters. We continue to enjoy a good credit rating from the system, which allows us to access funds at below 10% on an overall basis. And going forward, we feel that the kind of a guideline what we have given for this financial year, that 1.15 or so debt to the equity, we should be able to maintain. So the cash flows, the debt equity, the growth, the margins, all such things we feel they are falling in place in a difficult environment. And hopefully from this financial year onwards coming, what I mean, things should start looking significantly better both for the sector as well as for our company.
Talk to us about your overall pricing trends across geographies, any uptrends that you expect that can help improve your overall realizations?
See, we definitely have tried and met with some success as far as the realizations are concerned. But when we look around, we find that somewhere the price rise still is not available to the developers. They need to be cautious. They need to ensure that the demand rise happens first, and maybe when the overall inventory levels in the market is not there, or it comes down significantly, chances are the price rise can happen. But from the margin perspective, on the other hand, till you feel that you can protect your margins, we are not unduly worried on the realization front. We are trying to see that somewhere the overall demand sentiments should improve, and with this interest cut, chances are that things should start looking up from now onwards. Quite confident that this new budget also should help this sector to revive the demand, where hopefully this government should provide some kind of a tax benefits both to the developers as well as to the home buyers.
You know, you've indicated that good traction in luxury and super luxury ongoing projects is what you witness across cities. What is your sense of how the segment is likely to pan out?
See, it's a good point. If you really look at while the focus to sell affordable homes should not be diluted, there is a large market which is quite profitable as well from the developer's point of view on the luxury segment, which I feel is above 1 crore rupees, between 1 to 2 crore depending upon the city and the location, where a 3-bedroom apartment 1500 square feet to 1750 square feet is the ideal choice for most of these persons whose per cap annual income, the family income is in excess of 25 lakhs rupees. And these kind of customers are reasonably sticky customers and would like to own it for the lifetime. So we are focusing on this segment, and we have seen with our Royal Pavilion sales that this segment is doing reasonably well. In times to come, from the new launches point of view also, lot of emphasis has been given to this segment, where 1 crore plus apartments will be sold in greater numbers in the next coming financial year.
All right, and what about the contractual side of the business? How has that performed? Are you scaling up this vertical? And as of now, what kind of a percentage is it for your total revenue mix?
See, this backward integration model of our company has indeed helped us during these tough times. This is the segment which had grown the fastest, and right now it constitutes about 1/3 of our total revenue. This year also it should be showing 20% plus growth, and looking at the visibility, we hope that the coming year 2021 also should be having 15 to 20% growth on the contracting side. So this is one segment which is indeed helping us in ensuring that the overall top line and the bottom line growth is maintained, and we are quite confident of growing this segment even from this higher base in the coming years.
Mr. Sharma, great to have you on the show, and here's wishing you a very happy 2020, not just personally but business-wise as well. We really do hope that the real estate sector finally sees that much needed and awaited revival. On that note,